SpaceX dropped 10.5%. Lab scores at 55 out of 100. Hold. The 841 times forward P/E hinges on Starship slashing launch cost per kilogram to orbit. Without a proven cadence, that multiple evaporates under realistic cost assumptions. Our full teardown exposes the fragile math, hidden launch rate risk, and the ultimate real upside ceiling. SpaceX is currently a hardware liability because its $2.2 trillion valuation hinges entirely on Starship achieving a payload mass fraction, the ratio of useful cargo to total rocket weight, of at least 3%. While the Falcon 9 is the industry workhorse, its 22.8-ton limit to low Earth orbit is a physical ceiling that competitors like Rocket Lab's Neutron are already targeting. The lab looks at the Raptor 3 engine's chamber pressure. At 350 bar, the unit of pressure equivalent to 350 times Earth's atmosphere. It is the most efficient liquid oxygen engine ever built. However, 10.5% drop to $165.55 proves the market is finally pricing in the thermal protection system failures that threaten Starship's reusability timeline. Quarterly financials showing modest revenue momentum for SpaceX. By Q4 2026, the normalization of the yield spread, the difference between long-term and short-term interest rates, will compress SpaceX's valuation multiple as capital shifts from speculative growth to realized cash flow. The lab is watching the $9.7 billion government contract backlog as the only floor for this stock. While headline news frets over a 10.5% slide, the real friction is the 3.63% Fed rate, increasing the cost of the massive capital expenditure required for Starlink's satellite constellation. With a 4.49% 10-year yield, the discount rate on future Mars missions is rising. Furthermore, potential tariffs on specialized aerospace alloys could shave 200 basis points, or 2%, off gross margins. SpaceX isn't just fighting gravity, it's fighting a tightening cost of capital. Management's headline: "We are well-positioned for long-term growth," a phrase meant to calm investors while sidestepping any near-term cash flow worries. The lab sees the opposite. No insider trades. Yet the 8K is just a boilerplate sign-off from CFO Brett Johnson, a classic "we'll update later" move that precedes earnings volatility. R&D now consumes 46.3% of revenue, up 149.5% YOY, signaling a cash burn sprint rather than steady expansion. Oppenheimer lifted its price target to $250, but ARK's daily holdings remain flat and short volume sits at a baseline 51.4%, showing no fresh buying pressure. What management says is confidence. What the lab hears is a funding gap masked by hype. Call bragged record demand. Filing drops the word, replacing it with vague future opportunities, a red flag for auditors. Watch the next 10Q for R&D as a percent of revenue slipping below 30% or the MD&A removing the future opportunities qualifier. Either shift flips the narrative. The momentum breakdown for SpaceX. RSI sits at 50, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. SpaceX's bull case is built on Starship collapsing the cost per kilogram to orbit, justifying its 841x forward PE, the ratio of stock price to projected earnings per share. But here's what breaks the thesis. The FAA's launch cadence is a hard bottleneck, and CFRA's $115 price target reflects the massive valuation risk. The critical question: can SpaceX sustain 15.4% revenue growth, while IDR, federal laws restricting the export of space technology, blocks international expansion? The lab's previous buy call at $209.96 was wrong. We underestimated governance-related volatility. If Starship achieves orbital recovery by Q4, we target the $187.80 analyst mean. If regulatory delays persist, we crash through $157.27 support. Our AI score of 55 demands patience. Here's the macro picture shaping SpaceX. Recent Federal Reserve interest rate cuts lower the borrowing costs for capital-intensive satellite manufacturing, while escalating global conflicts increase government demand for secure military communications. However, strict U.S. export control laws under IDR prevent the company from selling its advanced rocket technology to foreign allies, limiting international revenue growth. The company dominates the global launch market because its reusable rocket boosters operate like commercial airplanes that can land, refuel, and fly again instead of being discarded after one use. This massive cost advantage forces traditional competitors like United Launch Alliance and European rivals to completely redesign their expensive single-use rockets. Over the next 6 months, the successful orbital launch of the massive Starship rocket will unlock cheaper heavy payload deployments and act as the primary driver for stock growth. Conversely, any unexpected regulatory delays from the Federal Aviation Administration regarding launch licenses represents the biggest threat to this tight schedule. Signal: SPCX's hold rating reflects a neutral momentum shift. Have you traded SPCX before? Profit or lesson? Tell us in the comments. We're not giving financial advice. This content is purely educational, and you should conduct your own due diligence before acting. Past performance is not indicative of future results, and any trading decisions are your responsibility. We stress that market conditions can change rapidly always. Subscribe now for deeper engineering insights you won't find elsewhere. If you want our full breakdown on Intel, the link is in the description. Stay sharp, and see you next time.